All right, so welcome back to the last lecture of accounting here. We got one more lesson, chapter 13, but chapter 13 is more on how to wrap up the end of the accounting period. So this one's going to actually be the most solid lecture that we're going to be needing to know for this purpose of learning payroll, okay? Payroll. So payroll is going to be when you have employees and you're going to pay them for their for their work, right? So in this case, when we are deciding to have employees, we need to think about many things that come with having the cost of having employees. We need to be able to determine what kind of employees that we want to employ. We need to determine how are we going to pay them through the compensations. So whether we pay them on an hourly basis, on a salary basis. We also have to think about the taxes that we have to pay for the employee and also the employer's responsibility. We have to also decide, are we going to offer to have benefits such as a 401k plan? Do we offer any deductions such as having medical insurance, healthcare insurance, vision, dental, whatever kind of life insurance, right? Anything that you kindly want to offer to have for your employees to be feeling protected and very welcome when they are working at your company, okay? So that's going to be a very big decision because, once again, it's one of the basic functions of a business, right? If you break down the business into three categories, right? You have your customers that you are trying to sell a product and service to. You have your vendors, which you are buying those products and services to buy to sell to your customers. And you also need to have a few employees to be able to help you facilitate the distribution of, providing those products and services to your customers. So at the end of the day, this is definitely something that's going to be one of the most important parts of your business is employees. And you need to think about all of these things that come with having employees. So first thing you got to do is you do need to have a taxpayer identification, right? So in this case, as a sole proprietor, or anybody that's an independent contractor, or if you own your own business, or for instance, if you're trying to use your own social security number, a social security number, right, identifies you as an individual, right? It comes from the Social Security Administration, and basically this code or this identification number defines and identifies you as an individual. So normally it's your first name, last name, and the digits are going to be 3, 2, and then 4, right? But however, you need to know the difference between a social security number versus an EIN, which is an employer identification number. Your employer identification number is also going to be your tax ID number, right? This number is going to be distributed by the IRS themselves, right? And what this employee identification number does is it keeps track of all the taxes that a business needs to pay for anything, for having a business, right? For having employees, for, federal and state taxes, right? Or even sales tax, right? You need to have some kind of identification number to associate that you are a legitimate business, and this is the identification number that defines you and separates you from any other business. Okay, so again, a sole proprietor can have one, a partnership, a corporation, a limited liability, any type of form of business would normally have a employer identification number. Now, like I've mentioned earlier, as a sole proprietor, yes, you can use your own social security number. However, remember that principle, the economic and business entity. This is also another example where you don't want to mix your personal social security number and mix it with your business, because then when you file taxes, you're going to have to file taxes 2 separate times, right? One for your personal and one for your business. So best way to do is just apply for a business identification number so you're able to, make that defined difference between personal taxes and your business taxes. So in this case, yes, you can apply for it. Again, most independent contractors, which are usually self-employed, would use their social security number, but they can also apply for a business identification number. Now again, because it's from the IRS, a business identification number is going to be in this exact form, 2 numbers and then 7 digits after that. So in this case, the only difference that's between the two is they both have 9 digits that they're using. The only difference is how many sections are they broken up to. So this one's 3, this is 3, 2, 4, this one's 2, and then 7. Okay, so that's how you're able to identify an individual person versus a business. Okay. Now, of course, how do you apply for one? Normally, when you apply for a business state license, so if you go to any website, so if you're applying for a Nevada license, oftentimes you're going to automatically apply for a employer identification number, okay? Depending on which website you go through, if you're going through an actual agency that can help you that. So if you're going to, whether it is the state agency or something that's remotely like a IRS, like maybe a small little branch of it, you are still going to be required to fill out this form. You can retrieve it from the irs.gov. It's called the SS4 form, where you're applying for a business identification number. So employer identification number, EIN. So this is what you need to do. Okay. Now this is important because you're going to need your business you need to have your legitimate legal documentation that you are a business. Okay. So you do need to acquire your business license ahead of time, because that's going to give you your legal business name for you to be able to apply for an EIN. Now, once again, like I said, normally when you apply for a business license, they automatically have you apply for the employer identification number. In case you do get approved, you have an identification number. If you don't, then you don't get one, right? So in this case, you do need to have your legitimate information, such as your legal business name, and if you have a location, then you will fill in your location. Okay. So let's talk about employees. Okay, so employees, there are many different types of employees. Okay, if you are interested in learning more about employees, there is a form that you can actually take a look. It's on the irs.gov website. I believe it's called Publication 15, and it will tell you about every single employee that actually is in existence. However, we have to be able to identify the more common types of employees that you normally see nowadays, right? So here there are 6 that we normally see, but of course the list goes on, right? This list doesn't include if you're a family-owned business, how do you account for your family members who are working for your company, because they do get taxed a different way. And then, of course, if you are, employing anybody that has, a disability, how do you manage their taxes and things like that? So there is a lot of different specifics when it comes to those types of workers, right? How can I go about that? And if you are planning to have employees, I do recommend you to take the time to go to irs.gov or actually seek a actual professional tax accountant to get more information on those. But this is going to be the normal 6 that you would actually normally see in a real life setting, and I'll go ahead and give you examples of each and every single one of them. But the main focus for this is we do need to keep in mind of our common law, which is our regular workers, and our statutory employees, because those ones are going to be the ones that exist on your payroll. Okay? So, common law, and what can they do for you? So common law, also known as your regular employees, these ones are going to be the ones that you have full control over. So how we determine the different types of employees is based on how much control we have over an employee. So the typical common law employee or your regular worker, you have to give them the task. You have to tell them when to show up, when to clock out, where to work. You have to provide all of the equipment and necessary things for the employee. So in this case, you have almost a full control of the employee. Okay, so that means you're telling them what to do, you're telling them how to do it, you're telling them when to do it, and you're telling them exactly how the end result is going to be. So again, full control over the every decision that your common law worker is going to be. So this is your typical Monday through Friday, 8 to 5 type of worker. Okay? So again, it's determined based on how much control you have over them. In this case, you have pretty much 100% control. Okay? So those are your common law employees. Other ones are going to be your statutory employees, right? They function very similar to common law, except the only difference is the task that is given, right? And the when to show up is going to be set in standard, but the only difference is the amount of time or the amount of effort it gets to the end result will not be determined, right? So for instance, a delivery truck driver, yes, they work for you and their job is to deliver, maybe for example, a grocery store. You have a delivery truck driver who, picks up those groceries to bring it to the store. They're given the exact task, they're given the end result. However, they're scheduled, maybe, hey, clock in on Monday, go ahead and do your daily deliveries. However, at the end of the day, the time frame, right, is undetermined because we don't know if they're driving on if they're driving from one state to another. How long is that drive going to be without considering other factors such as traffic, such as things like an accident, or things such as if it's an overnight shift, right? What are the chances that they're going to be awake at that time? So again, truck drivers is going to be one of those examples where they are a statutory employee, where they do work for the company. However, yes, the task is given, the end result is given, the time to clock in is given, but the amount of time that is dedicated to this job is unpredictable, right? So again, another example would be a full-time life insurance, right? Everything's provided, right? But their job is to sell the insurance to the companies, to other companies or other employers, right? And if they get it, they get it. If they don't, then they don't, right? Because that's the task that's given. It takes time to, sit there, talk to an actual individual to get them interested in purchasing life insurance. So again, everything's going to be based on the control of the employee. In this case, we do have full control. Everything's provided. The task is given. The end result is given. The only difference is how much effort, time, and labor is actually going to go there. That is the only unpredictable part there. You can't tell a truck driver to clock in at 8 o'clock and be at your store by 10 o'clock. That's unrealistic. Okay? So that's going to be something that they do work for the company. However, the time frame, maybe their shift too is not every day. They might have to show up every other day or something like that. Okay? So now that we understand the common law versus the statutory, these two types of employees work for the company. Okay? They work for the company. However, there is a huge difference between them because a common law worker, right, has a standard schedule. You clock in on Monday through Friday from 8 a.m. and you clock out at 5 p.m. They have a set steady schedule. So for the common law, you as an employer is responsible to pay into their federal Insurance Contribution Act. So that means you're responsible to pay into their Social Security and Medicare, and they are also responsible to pay into their own federal income tax withholdings, okay? Because they have that steady 40-hour, they meet that labor law, right? So in this case, they are mandated to have these things taken out from their paycheck, and you are, as a responsibility, need to also cover into their Federal Insurance Contribution Act, okay? FICA for short, okay? However, for your statutory employees, because they're not constantly coming into the office and their schedule can be unpredictable, for them, they are not responsible to pay into their own federal income tax. However, you are still responsible to help pitch in for their federal insurance contribution act, meaning you need to pay into their Social Security and Medicare, and they need to pay into it as well because they are working for you, but their hours are not the same as a common law. Okay? So that's something that you need to know, because this is important for when we dive into payroll, because these right here is going to determine how much taxes you need to withhold on an employee's check and how much taxes you need to pay for having those employees work for you. Okay? So those are the two types of employees that are normally going to be commonly on your payroll list. Okay? The other four that I'm going to talk about are going to be just mere expenses to your company, right? You hire them, right? And you just pay them for the job that they've done. And these type of individuals are going to be responsible to pay for their own income tax through their personal income tax. Okay? You are not responsible to pay anything for these individuals unless you provide like maybe some kind of insurance plan that they can buy into, but you're not going to cover them. Then that's different, right? But in this kind of situation, these typical types of employee, or they're not employees, they're workers, are going to be just mere expenses to the company, meaning they come in, they clock out, they tell you how much hours they worked, you cut them a check, and that's it. You're not responsible to pay into their Social Security, their Medicare, federal income tax withholdings, unemployment. You're not responsible. Okay? So again, these are just mere expenses to the company. So you have your non-statutory employees, okay? So as we remembered, the amount of control you have over an employee or a worker is going to determine what kind of type they fall into. So again, your statutory non-employees are going to be people who work at an agency who have their own separate jobs, right? So for instance, a real estate agent, right? All of them work under one housing unit, but each and every single one of them works for themselves. They get to come into the office whenever they have a client. They get to make their own hours as they please. So in this case, yes, these types of employees are based on their own criteria, right? So, but they still work for an overall umbrella company. So for example, right, maybe they're working at Real Estate Co., right? But every individual that is a real estate agent will have their own commissions, will have their own clients, will come in whenever they like, and so on and so forth, right? So that's the difference here, is that they are nothing like a statutory employee, okay? This one, they get to make their own rules and their own regulations and so on and so forth, right? But the thing is, here's what's the difference here. The end result is the same, okay? Because at a real estate agent, the end goal is to sell a home. Doesn't matter when you come in, clock in, have your clients or not, the end result is the same. Everybody needs to sell a home. That's the end goal, okay? Where an independent contractor will differ, because in this case, an independent contractor will work for an agency or work for an organization. However, the end result will vary. So a great example is going to be a doctor's office, a dentist's office, right? Because every single doctor that works for the company, so maybe they work for UMC, for example, right? UMC is the organization that they are working at, right? However, every individual doctor will provide a different, a different opinion, a different diagnosis, right? No one is the same. However, they also are going to come into the office whenever they choose to. I have booked an appointment, then they come in whenever they want to. So they're getting paid as an independent contractor, right? They work for the organization. However, every individual person is normally have a different end result. So that's how you different between the two. Okay. So independent contractors get to come in when they like. Now again, some of them, right, they're still gonna all file a 1099 form, but they're gonna claim on that 1099 form what type of employment they do. So again, your not statutory employees are gonna put in whatever they want to put in. Normally, independent contractors, they put themselves as self-employed. I'm not I'm not an expert on the 1099 form, but it is definitely something good to know. On a 1099 form, there are different types of employment statuses that you can choose, whether you're self-employed or independent contractor or whatever that you want to claim yourself as. Okay, so again, those are there. And then of course, all income taxes, all federal income taxes are going to be manually paid through their individual personal income. Okay? All right. And here's a common one here in Vegas. You're going to normally see leased employees or temporary work agencies. So here in the state of Nevada, we have many temporary work agencies here that help other businesses. So a lot of companies will call these headhunters and ask these type of agencies to look for work for them or look for people who want to work for the company for a temporary project or time frame, right? So usually these are temporary work, meaning it's a project that's in a small short time frame, or it could be a long project, but the idea is it's work based on a project or a task that needs to get done. So that is given and the time frame is given, but the temporary work agency, what they do is they find those workers that are available to go ahead and work for that company temporarily, and then once that job is done, then they would work for another company temporarily for the next job. Okay, so in this case, the company does not pay the worker itself. They actually pay directly to the company, and then that company or that temporary work agency is going to pay the employees that way. Okay, so again, that's the huge difference that you need to know is you're not paying for the workers. You're paying the company that you hired to go ahead and find those workers. Now, I've seen a cross between these two because what often happens is when a work agency allows the people who are working for the company to find a permanent residence, then they allow many companies to give them the opportunity to have them as a leased employee, okay? Where they can buy them out of their contract, right? So buy them out of the temporary work contract, have them employed for a few moments in time to let them see if they can be potential employees, and then they go ahead and employ them full time if they see that this is a potential quality employee. So that's a lease worker. Is usually they are going to be bought out from the company. However, same situation. You are not paying the employee themselves. You're paying the work agency that's being leased by the company. And what you're doing is you have the potential to buy them out of their contract to have the potential to fully employ them. So again, a lot of MGM properties are doing that right now. So anybody that's been working with some kind of headhunter, they do have that hopes that from these temporary work agencies that they are seeking to get quality employees. Okay, so in this case, that is a cross between a leased and a temporary work, is that they are contracted. So again, a lease employee, right? You're contracted to work for MGM for 6 months, and if you want to buy out the contract, then you can. So that's a huge difference there. Okay, but once again, these are, you don't even pay the employees themselves or the workers themselves. You're paying the agencies or the contracting license company for these people. right? So that's why they don't belong in the payroll either, because you're not paying them on the individual. You're paying a lump sum money to some company for these people, okay? So that's why they're not on the payroll, okay? So again, now that we talked about the different types of employees that you typically see here normally, let's actually start talking about the payroll process, okay? So as we remembered, only your common law and your statutory employees are the ones that will actually be on your payroll, because everybody else, you just either pay them for the job that they've done, or you pay the agency for getting those people to be at your job, okay? So the people you actually pay are going to be your W-2 employees and your statutory employees, which is your W-2 employees. Okay? So let's understand the process of how we get our payroll started, okay? We have to divide the payroll process into two sections. You have your employee section, and then you're going to have your employers section. So again, we're going to divide the class today in these two parts. So the first part we're going to focus on is going to be the employee, okay? What are the employees going to be needing to do to be able to, get paid? So in this case, step one is you need to make sure that they are legitimate employees into your company, okay? And then, of course, step two is you need to collect W-4 forms, okay, for taxes purposes. And then step three is you're going to determine, again, how often you're going to pay them, how much you're going to pay them, when you're going to pay them, and so on and so forth. Then you're going to calculate their earnings and so on and so forth, and calculate their taxes. And then, last but not least, you're going to record and then send to print the checks, okay? So let's go ahead and walk you through all the steps you need to do to have actual employees. So number one thing is you need to make sure that this is a legal transaction, okay? You're not paying these employees under the table. You are legitimately hiring them and having them work at your company and make them recognize that they are working. So they're going to be actually needed to be submitted to the Department of Employment, so whichever one it is, depending on the state. In the state of Nevada, it is it's DETR, Department of Employment, Training and Resources. Okay, so make sure, rehabilitation. So in this case, that is here, right, in the state of Nevada. We have DETR around Las Vegas. That's the agency that you're needing to have to file a form to. We're going to be needing to file to the actual agency for the state an actual W-2 form. Now, do not confuse the W-2 form, because yes, the employee gets the W-2 form, but this is how it works. You, as the employer, need to submit the W-2 form, okay? This is to let the state know and the federal agents know that you have employees. And on this form, you need to fill out their legal name. You need to identify what their job is, what their tasks they do, what pay rate are they going to be doing, and so on and so forth, right? You need to identify all those information, including their social security number, because again, this is ultimately how you and how the state also keeps track of those employees by their social security number, right? Collecting all those state unemployment if there is any, right? And so on and so forth. So it's important that you do submit this in, because they need to be legally working for your company, okay? So that means you need to put, as an employer, you need to submit a W-2 form to the state agency, so in this case, DETR of Nevada, okay? Once you've done that, then the next step is to go ahead and process a W-4 form for your employee. Now, in this case, this is a mandate, because this is going to require you getting information on how much the employee wants you to withhold taxes from their paycheck, okay? So again, every person is going to be required to fill out a W-4 form and submit it to the employer. Failure to do so will be subjected to a the highest tax bracket rate with zero withholdings and so on and so forth. So you're going to be taxed at the highest amount, okay? Now, what the W-4 form does is it allows you to claim, you as the employee, to claim any tax deductions from your paycheck. And then they get taxed after that. So for instance, if you want to claim your home, if you want to claim your children, you have a bunch of different deductions that you want to take, alimony, right? You can go ahead and fill that file out for the W-4 form to go ahead and process this into the employer, and they would withhold from your paycheck. Okay? So that is important for employees to know and for employers to know, right? How much money does the individual employee want you to withhold from their paycheck? And that's ultimate, right? And again, I am not the tax accountant here, but for most cases, if you choose to claim this, claim that, claim this, claim that, you're higher likely to have to pay back the government because you end up taking too much money when, the purpose of having federal taxes is ultimately to support the federal government, and then eventually that money will come back to you when you do your retirement, right? So that's the purpose of that right there. So in this case, federal income tax withholdings, this is where we're going to be needing to know what kind of filing marital status are you going to be, right? Are you single? Are you filing separately? Or are you filing married as joint? Or are you the head of household? Okay? We need to know this information so we can pick the correct table to go ahead and calculate your taxes for. Do you have any extra jobs? So in this case, right, let's go ahead and take a look at an actual hard copy of the W-4 form for 2022. Now, of course, every year you will be subjected to a new tax or W-4 form. So right now, since we're still in 2022, this is actually going to change in a couple weeks here for the W-4 form for 2023. It should be similar in nature. There's not that much difference, but if you've already have applied before in your previous life, you know that it was definitely different from the W-4 form from 2018. 2019 is when they officially made the changes to the W-4 form. Okay, so make sure you are aware of that. But of course, if we're talking about looking forward into the future, right, and you're trying to look for employment now, you're going to be needing to fill in the W-4 form for the current year that you're applying for. So in this case, here's to the 2022. You need to fill out your name, your social security, your address. You need to also identify what kind of marital status you are. Now, in this case, this takes into consideration if you said you're going to be filing jointly, they're going to require you to put in all the income earnings that your spouse is also generating as well. Because when you select that you're filing jointly, they're looking at your overall income for your entire household. Okay? If you decide to file separately, but you have multiple jobs, they are also going to be requiring you to list out any other job. So now, of course, nowadays, with the feasibility of now doing a full-time job or full-time regular job and then also doing a little night shift, maybe I'm doing Uber at night, that is going to be considered extra income that you're generating for your social security and things like that, right? You're generating more income. So therefore, this is going to give you a reason to not have to file multiple W-4 forms for different places. They want you to file one and one and only. Okay? So in this case, back then, you would have to file a separate W-4 form for every employer that you are looking at, right? In this case, they are looking at your overall amount of generated income that you produce. So if you have a secondary or tertiary job, you're going to need to report every penny, every earning that you have. So in this case, that's what step 2 is. Is there any other extra things that you have in there? Okay? Then step 3 is going to be any deductions. So again, this is more for your company. If you provide if you provide, for instance, if you are needing to do alimony or any of those things are going to be taken out, okay, because it's a deduction from your pay. Or if you have garnishes, which is a legal contract for those of who are serving time, they do require that it is paid back to the specific agency, right? So in this case, those are the things that you're going to be needing to report here. Are any other extra deductions, right? This also includes, right, in step 4 or step 5, step 4, if you have things like stock, you're going to need to report that. Even though that's not part of your income, that's why it's step 4. Step 4 is any other extra income that you have that's being stored away or withheld. So in this case, for instance, stock, you cannot cash it out right away, right? That's something that you're storing for future purposes, right? So in this case, that is still money that you have, but it's not part of your income. So that's where you have to make sure that you are aware. So step 2 is going to be determined adding up all of your extra income that you generate, whether it's with a spouse or with your secondary, tertiary job. And then step part B is going to take out any deductions that are mandated by whether it's federal or state obligations, right? You got to take that out. Okay. Then once you figure that out, step 3 is where you're going to need to figure out how, if you're going to choose to claim any dependents or not. So in this case, from this federal worksheet here, they say that every child that you get to save is going to be $2,000 per year. $2,000 per year for a child, okay? In this case, that is definitely not possible, right? But in this case, this is $2,000 that you can claim up per child that you can actually, you would receive that that $2,000 per child, okay? And then, of course, if you have other dependents, there are $500 per person, okay? So again, yes, you can claim your child up to, I believe it's up to 18, and then you can claim them as a dependent up to 26. Okay, so yes, you want to make sure that you are aware that, or in this case, age of 17. Up to 17, you can use them as a dependent, but by then, the federal's saying that by 18, they should be able to support themselves, but you could still claim them as a dependent if they're still currently living under your household and so on and so forth, right? So again, I'm not a tax accountant here, but that is what this statement claims here. Now, of course, you can also claim other individuals with disabilities, right? If you're taking care of your parents or things like that, they're going to be considered dependents. Okay, so again, you can claim up to as many as you'd like. I believe the threshold is up to 10 individuals that you can claim. But like I mentioned, the more you claim, the higher chances you're going to have to pay back the government instead of getting a tax refund. So in this case, there are ways that you can claim them at the end of the year. So after you've been paying into whatever it is that you want and you want to claim them at the end of the year, yes, you can claim at the end of the year, and it's going to be, whatever the 2,000 times the for the full year is per individual, per child, per dependent. Okay. So that's where you're going to need to claim your children or dependents in step 3. And of course, step 4 is going to be any other income. So again, if you own stocks, if you own, if you own a cryptocurrency, that's going to be something that's going to be considered income that is not from a job, but is from your savings. Any life insurance savings, any IRAs, anything like that is going to be considered extra income. And any other extra deductions, such as if you want to claim for your home, if you want to claim anything else that can take away your from your check. Okay. And then that's where you're going to determine any other extra withholding. So again, there's a lot of different ones. So you could definitely go ahead and go through the IRS. They do have a website, a link where it can actually help you determine what your total what you want to claim on your taxes to be able to produce that. So right here, irs.gov/app. Okay, so the W-4 app. This will actually allow you to go ahead and do it. They used to have what's called a tax generator. So in this case, you just follow this link here and it will show you how to fill out your W-4 form if you are confused. But it's very simple. It's an easy walkthrough process. They literally ask you questions and you either say yes, no, yes, or no, and they will generate the W-4 form for you and give you your highest amount of tax breaks if you need it. Okay? So again, that is the really cool thing about this little application. It will allow you to give you not only your W-4 form produced for you, but it will also allow you to claim the highest amount of claims, that you're allowed, okay? But again, the more you claim, the more likely you're going to have to end up paying taxes at the end of the year. So best rule of thumb is, if you can be able to afford it, try to do the zero withholdings because you have a higher chance of getting your money back, a tax refund, versus claiming everything now and then ending up having to pay afterwards. So that is the W-4 form for the new current 2022. Once again, 2023 is right around the corner. So of course, this is going to be a new form that you can get at irs.gov. All right. So any questions so far? Okay. All right. So now that we have talked about the W-4 form, right? Once you've collected that from your employees, this is what you need to determine next. How often are you going to pay your employees? Okay, now here are the more common ones on the left side. The right side are more, maybe not so much. Okay, so again, you can pay your employees based on the daily. So things like Uber allows their employees to actually cash out their earnings at the end of every single day. So therefore, that's a payment that can be done every day. Or it's also called a miscellaneous payroll period. Now, the more common ones that you normally see in a real business setting is a weekly payment, bi-weekly payment, and semi-monthly. So again, weekly, right? They get paid once a week or every week. So that means they get 52 paychecks. Bi-weekly is every other week. So this one is a definitely more common one amongst the wage earnings, the one that are being paid by the hour, right? They are normally paid on a bi-weekly status. So that means they get paid every other week. And because there's 52 weeks in a year, they get 26 paychecks. So every 2 months, they'll get 3 paychecks for that month, okay? Where a semi-monthly strictly means that they're going to get paid twice a month, okay? So that means normally for salary-based earners, usually they get paid the first 15 days and then they get paid for the last 15 to 16 days. So normally their paychecks are going to either derive on the 16th, so the first 15 days that they worked, they'll get paid on the 16th. And then from the 16th to the 31st, then they'll get paid on the very first of the following month. So they get paid they get paid twice a month, okay? Now, other places that do monthly payments, so again, anybody who is, a beneficiary or someone who is claiming Social Security or any retirement money, usually they get paid by the month. Okay, so that's why it's a common one that you see normally is that anybody that's receiving any government assistance or anybody that's receiving pension plans, retirement plans, they usually get paid at the end of every month. Okay, and then a rare one would be quarterly. Of course, it does exist, but how often are you going to pay someone who is on a quarterly basis? So these are more for those that are like travel agencies that only work every so often a month. So they will most likely get their earnings every quarterly. Semi-annually, probably not likely. That's probably the least likely that you'll ever have someone get paid at the end of 6 months. And annually is just a term that we use to represent how much you would earn on an annual basis, okay? You're never going to get paid at the end of the year, all right? So that is definitely something that you want to know. Okay? So once you establish what kind of payroll frequency that you're going to establish, then now we can start moving into actually figuring out how you're going to pay your employees through the different compensations. You need to determine, right? You need to determine all the benefits and deductions and anything that you want to provide your employees. So the first thing we're going to do is looking at how we pay our employees. Well, you could choose to pay them as a wage rate or an hourly rate, or you could choose to pay them salary. Okay? Now again, if you choose to pay them on a wage or an hourly rate, this is going to be determined by the federal minimum payment. So in this case, right now, this is a little outdated. I keep forgetting to update this, but the minimum payment in the state of Nevada is actually, I believe it's $10 now, $10.25 if I'm not mistaken. I have to double check that, but I know it is higher than it was. 2 years ago, it was $8.25. But due to the pandemic, it has gone up in price or in cost. So in this case, the federal minimum is usually the baseline that you start out your your wage rate with, right? And you would increase it based on whether you can afford it, or two, if you don't include other things such as tip earnings, commissions, or bonuses and things like that, right? So for instances, anybody that works at a casino, some of them, they count their tips towards their earnings. So that means the wage rate can fall below the minimum because they're using the tips to make up the extra income based off of that baseline. So again, yes, there are some workers out there who are getting paid below the minimum, but because they're having tips as included as part of their income, that makes up that difference, right? So in this case, that is an example of that you do normally see here, but some of them, depending on what kind of company you are working for, some of them use tips that go towards the income. Some of them you can actually just keep and pocket those tips on your own. It just really depends on who you work for, okay? And again, commissions or even for example, commissions, bonuses, all those things are extra. All right, and other earnable income, you could do overtime, right? Bonus and commissions. Okay. Whereas for salary workers, once again, you're going to get paid for a flat rate, a flat paycheck every single paycheck you get, and it doesn't matter how many hours you work. Okay, because you're going to get paid the same amount. So whether you are a salary earner and you invest either 40 hours or even 36 hours, it doesn't matter. You're still going to get paid the same amount no matter what. All right? So in this case, these typical types of extra earnings could come or with a salary is that even though you're going to get a standard flat check every single paycheck, other things that you can have is going to be bonuses and commissions. And of course, overtime, it depends on the company. If the company allows you to earn extra money on your overtime, then that's going to be up to the company policy. Okay? But most cases, overtime is actually looked down upon because if you're a salary earning type of individual, it's kind of in the job description where you're supposed to be able to work even though you can work overtime, okay? Because you're already getting paid for that time frame anyway. So in this case, whether you're overtime or not, okay? But again, that will depend all on the company business, okay, and the company policies that they want to contribute. Other things that you could do is any employee paychecks. So for instance, what other extra things that you can add to an employee's paycheck. So again, if you offer any fringe benefits. So fringe benefits is going to be like if you work for a company and they can get exclusive tickets or discounts for different companies. So for instance, any like the company that you work for can offer triple A insurance at a lower rate, can provide telephone bills for a lot cheaper, because what this company does is, because if they provide these extra fringe benefits to you, because you're using their company's name, these companies actually use those types of other companies to partner up, or they use them as a means um, to expand their network, right? So for instance, if your company uses AAA and offers AAA to the employees at a discounted rate, that will be considered a fringe benefit, okay? So for instance, a lot of companies in California that work with or support other companies, they usually do that. They trade off services to one another and say, hey, if your employees want to, get some discounted tickets to Disneyland, they may do so, right? That's going to be considered a fringe benefit, and it could be a deduction to your actual paycheck. So you might have to pay a little price for those benefits, okay? Other things are going to be holiday pay, vacation pay, sick pay, retirement benefit plans, such as 401k. Other things include insurances for vision, health, and dental, and life insurance. Those are going to be also additions to the check. Okay? So again, these are benefits and deductions. So again, you're not adding to the check, you're subtracting the check, but then you get those benefits for those things. Okay? So vacation pay, PTO, personal time off, or sick pay, right? Those are going to be additions. Subtractions are good. Deductions are going to be your 401k, your medical, health, vision, dental, life insurance, okay? So any of those are going to be extra things that a company can offer, but not all companies will offer this, right? Every company is going to have a per case scenario, right? Whether they choose to match you or not, especially with a retirement benefit plan, usually they'll have the quote either dollar per dollar, or they'll match you 50% of your paycheck, depending on, so if you put, like, for instance, the highest that I've seen so far is 6%, so they'll match you 3%, okay? Example. And of course, for insurance, usually you have three options there. You can either have the employees just pay for it 100%, or you can have a split where the company pays 50% and then the employee pays 50%. That's the more common one. Or if the company is very gracious, they'll go ahead and cover your entire health insurance plan for you. Okay? But again, like I said, most likely companies are going to go for the 50-50 split. Okay? Now, of course, what are the means for a employer to keep track of the employees is by simply having a clock-in tower. If they have their employees responsible to turn in their timesheets, that's up to that. It's up to you. If they have activity logs, if they have an hourly report, or things like that, okay? Or even, nowadays everything's virtually, so there is like a website that you can pay for employees to go ahead and do a clock in, clock out system, okay? And so on and so forth, okay? So that was all about employees and what you need to get them set up and get started with the payroll taxes. So let's see what employee taxes are subjected for at every individual's paycheck. Now, depending on the state that your business is in, right, will determine whether you are obligated to have to pitch into the state taxes or not. In the state of Nevada, you do not have any state taxes. However, you are obligated and mandated to pay for all the federal taxes. So in this case, on the employee side, the employee is responsible to pay into two federal taxes. One for federal income tax. So that means this is the taxes that everybody said that they were going to claim and that they are going to pitch in for the government. Okay? And then the second one is the Federal Insurance Contribution Act, which is the Social Security and Medicare. Okay? That's going to be also for the future for the retirement benefit plan, as well as a Medicare for the future for when you retire. Okay? So let's take a look at the first one, which is going to be your federal income tax withholdings. Okay? So your federal income tax withholdings is going to be a common law employee is going to be subjected to this federal income tax withholdings, which is going to be a calculated portion of the individual's paycheck that is going to be based off of a tax bracket, tax table. So again, the higher that you earn, the higher percentage you are, so the higher taxes, okay? Now, in this case, you will need to know this. Every year, the tax tables that will be released. So right now, they're currently passing, or I believe in November, they already passed the tax rates and everything. So now we're waiting till January to actually start calculating the new 2023, but because we're still in 2022, we're going to go ahead and take a look at that. Now, every year, the tax tables will change, okay? So again, where it's based on what the federal needs, okay? So again, the taxes is going to be changing every single year. So you do need to make sure that when you do process payroll, that you're using the correct timetable, okay? So how are we going to do this? There are two different methods that we can use to calculate the federal income tax withholdings. Number one is going to be the percentage method, okay, where we are actually going to determine the criterias for the taxes and looking up the tax table and determining which section they belong to, and then so on and so forth. So I'm going to show you the percentage method because the bracket method is not the greatest because it gives you a rough estimate of your federal income tax withholdings. It doesn't give you an accurate amount. So, and plus the bracket method it's too easy, right? You just literally look up all the parameters, look it up on the table, and boom, you'll find your federal income tax withholdings just like that. Okay? So in this case, I'm going to teach you the percentage method because it gives you a little more accurate information, and you will be needing to be using the circular e-table that is founded on the irs.gov/publication 15T. Okay? So I'll show you what that looks like in a few moments here. All right? So this is what it looks like. Okay? This is a example of a table, but I'm going to actually show you the real one from the irs.gov. So you will be needing to you're going to be required to make sure that when you are processing your payroll, this is the exact format you're going to be needing, okay? You can download this at irs.gov. All you got to do is search in publication 15-T, and this will give you the exact federal income tax withholdings table, okay? So this is how you're going to calculate how much money you need to withhold, and this is for the year 2022. Okay, so that means every year is a new tax table. Okay, now you're going to get a little table of contents to make sure that you know which table you're going to be needing to use, because that's also crucial to how you're going to calculate this depending on what kind of system you're using. So there's two different systems. So there's a manual payroll system and there's an automated payroll system. And then there is the percentage method, and then there's the bracket method. And then there's also going to be for the Form W-4 for 2020 and later. And then there's one for the 2019 and later. And then there's also one for the form for 2019 and earlier. Okay? So that means there are 6 different versions of each and every single table. Okay? So in this case, this very first one here you're going to see is the percentage method for automated payroll accounting systems. Okay, so again, we are not going to be using this one. Okay, but this is for when we dive into QuickBooks. you will be needing this exact table to be able to produce the answers that you need to produce. Now, this also gives you a step-by-step walkthrough of how to calculate your federal income tax. Now, this is very, very confusing, okay? So I'm going to break it down to you for you guys when we do the example in the PowerPoint, okay? But this is going to be based on these tables here, okay? And the table that we're going to be needing to use is going to be the percentage method for manual payroll system for the version form of W-4 form for 2019 and later. So let's see. So this one is number 2, which is the bracket method. So no. And then as you can see, the bracket method, you just literally look up the criterias and you'd be able to find your federal income tax just like that. That was the form for W-4 form for 2019 and earlier. Okay, let's see what this one is. This one is percentage method table for manual payroll systems with W-4 forms of 2020 or later. So this is the table that we will be needing to use. Now, for this class, I've already uploaded a copy of the W-4 form and the publication 15 form for you on the Google Classroom. However, anything that you are going to be tested on, and including this exercise, I will provide the table for you. You just need to know how to use the table, okay? I'm not going to require to make sure you know which one you're looking for, okay? So in this case, but I'm just letting you know there are specific tables for specific payroll systems for different types of forms. So that's why I need you to be very aware of what you're doing here, okay? But again, I provide the tables for you, so you do not need to worry. Okay? So let's take a look at the example here in our PowerPoint. So let's go ahead and take a look. This is the steps that we're taking a look at that we find in the publication 15 form that you will be needing to calculate this. Okay? So in this case, right, we got step 1, determine the individual person's earnings. Step 2, you need to determine all the extra income and extra deductions and things like that, because you got to take it out to get your adjusted taxable income, okay? Then your step 3 is going to be determining which table to use, which bracket to use, table, yada, yada, all that information, and we're going to calculate all of that. And then step 4 is to subtract any deductions. And then step 5 is to add any other additional tax withholdings. So let's go ahead and take a look at an example here where L is a single woman with 1 dependent, okay? And she only has 1 primary job. So that means she only has 1 sole income. And of course, she earns $15.25 per hour and worked a total of 45 hours. Okay? And of course, she claimed her dependents. Okay? And she has no additional deductions or withholdings. So, step 1, we need to determine her total amount of earned income that she's earned, right? So the payroll period is going to be weekly, and the total earned wages is going to be step 1, okay? So step 1, if she's earned a total of $15.25 per hour and worked a total of 45 hours this week, let's go ahead and calculate that. That is going to be $15.25 times 45 will give you $686.25. Okay, boom. Okay, we already stated that she has only 1 primary income, so therefore no additional income, and she has not taken any other extra deductions. So step 2 and step 2, part A, which is the adding the extra income, and step B is to subtract any deductions. In this case, she has none of that. Okay, so therefore that's our assumption. Is we're going to make it really sweet and simple, because that's going to be based on a per case scenario. And in this case, we're just going to assume there are no extra income and there are no extra deductions. So in this case, her total taxable income is going to be $686.25. So step 3 is going to be determining which circular e-table to use. So we are looking at this table. We said her filing status was that she's single. Okay, so that means on the left side here, we're going to be looking at single or married filing separately. Okay, and then we're looking at what kind of payroll period. In this case, she's getting paid every week. So that's this table here. And because she filed for the W-4 form for 2020 and earlier and later, this is the table. However, because she claimed that she only has one income, it says right here at the top, if you check 2 for any extra additional income, you're going to use the right table. If not, then you use the left table. So in this case, we're going to use the left table, and how we determine it is going to be based on her total taxable income. So in this case, she earned $686.25. So step A says she's earned at least, but not over, but less than, right? So in this case, step A, she earned $686. So that's definitely more than 0. That's definitely more than 241. That's definitely more than 433, but that's definitely less than 1,021. So that means this is the line that we're going to take a look at, okay? Now, how you read this table is going to be, it's actually fairly easy, but the way that they organized it is what's confusing, okay? How we actually go ahead and move forth is that now that we found the amounts that she's going to be in, so this is what it is. Letter C is going to determine that this is what the government's going to take from the paycheck no matter how much she's earned. Okay? So that means she's going to be subtracted $19.20 automatically. Okay? Now in this case, we're also going to be subjected to a 12% tax on any dollar over the amount of 433. So in this case, step E means this $433 is what the government allows you to keep without taxing. Right? So any dollar that you earn over that $433 is going to be subjected to letter D, which is the 12% tax. Okay? So that's how you read this. So let's go ahead and calculate this. So the first thing that we need to determine is she's earned, her taxable amount of income is that $686.25. We need to figure out how much the government is going to give to us free. So $433. So that's going to determine how much money she's earned in excess. So in this case, she's earned $253.23 extra. Okay? So this is the in excess. And because it's in excess, it's subjected to a 12% amount. That means she's going to get taxed at 12%. So in this case, now that we need to calculate what 12% of that extra money she's earned. Okay, so in this case, that gives me $30.39. Okay, then because the government's gonna take away $19.20 anyways, we need to add that to the taxable, the excess that was taxed already to give us our total federal income tax to be $49.59. Okay, so that's taking the extra income that was earned, taxed at 12% bracket, okay, plus the amount that the government's going to take from the paycheck regardless of how much that person earned, okay, giving you a total of $49.59. Okay. Then step 4 is you now go ahead and claim your child, okay? Back then, in the previous W-4 forms, you actually take your deduction from your child before taxes, never after taxes, okay? But in this case, with this system, they decided to change it, so now you're claiming your children, and it's going to be after you've been taxed, okay? So therefore, since L right, claimed her child on her W-4 form for that one child on a weekly payroll, this is what you need to do. You're going to refer to the W-4 form, right? So in this case, she claimed that one child, which was $2,000, right? No dependents, okay? And what you're going to do is you're going to take the table down below right here, table 5. Determine how many paychecks you're going to be receiving for the whole year. So in this case, because she's on a weekly payroll, she's going to get 52 paychecks. So what you're going to do is you're going to take that claiming of that $2,000 child, right? Divide it by the total number of paychecks that you have to get a total of $38.46. So that $38.46 will be deducted from your federal income tax. So therefore, right, if we've already claimed $49.59 for just her federal income, we're going to subtract $38.46 for her one child that she claimed, leaving us $11.13 to actually for her to pay for her taxes. So that's what I'm saying. When you claim your children, you're actually claiming money to keep for yourself to support your child. So that's what the federal income does right here. If you claim a child, that means you're going to deduct the amount of taxes you pay to the government. Right? So therefore, she's only subjected to $11.13. Okay? And of course, step 5, because she didn't claim any other extra withholdings, that's going to be 0. So that means her total federal income tax withholdings is going to be subjected to $11.13. Okay? And that's calculating federal income tax. Now, that was just one person. Think about it. If you had 20 employees with all different W-4 forms, how tedious and how much labor intensive is this? If we have to go through 4 different tax brackets, 4 different tax claims, and etc., etc. It's a lot of work to do payroll, okay? And that's why we have automated systems to do it for us, okay? So that's that one part. Now, that's just only doing federal income tax withholdings. The next section that the employee is responsible for is their Federal Insurance Contribution Act, which is their Social Security and Medicare, okay? So Social Security, also known as Old Age Survivors and Disability Insurance, OASDI for short, but better known as Social Security, right? Nowadays, it's more popularized as Social Security. In this case, these percentages have been predetermined by the federal government, and it has been 6.2% for the longest time, okay? So 6.2% is what the average federal agency, federal government thinks that when a individual retires, if they were to work for 40 years of their life, 6.2% of their earnings should be sufficient enough for them to support themselves after they retire. Now, again, that means there is a threshold. Only every single individual who wants who does the Social Security, who have to submit into their Federal Insurance Contribution Act, can only be capped at right now, currently for the 2022 year, is $147,000. Okay? That's how much the government thinks when you retire, that $147,000 is enough to support anybody who's retired. Okay, and I believe the age of retirement has increased yet again. I believe it's 67 now, if I'm not mistaken. Okay, so 67 is going to be when you can retire to receive your money, of course, in increments. You're getting monthly payments, okay? But it's going to take this $147,000 that you have saved and distributed over your lifespan, right? Okay? So again, because if L earned a total of $686.25, therefore, it's going to be based off of her gross earnings, not her income tax, okay? That's completely different. It's going to be based on gross earnings. So in this case, she earned $886.25. So 6.2% of that is only going to be $42.55, okay? So again, if you're looking at how much threshold this person is, since they are working $15.25 an hour, they would have to work at least 60, 70 years to even reach this 147, because this $42.55 is only for one paycheck, right? And if they're claiming 52 paychecks every year, you kind of get the picture, right? They will barely reach this threshold within the timely span. Okay. All right, and of course, Medicare, also known as hospital insurance, okay? So HI for short, but it's better known for Medicare, right? Which is going to be 1.45%. And guess what? There is no cap limit on how much money you can put into your own Medicare, okay? Because in this case, right, since medical expenses can vary over time, they do not have a cap limit. So even if you've already maxed out your cap limit for Social Security, you could still continue to pay into your Medicare. Okay? So again, example, if it's based on gross earnings. So if L has earned this much amount, $686.25 times 1.45%, which is going to be $9.95 per paycheck. Now that we determine all the very basic necessities, which is going to be the federal taxes, anything extra, such as your benefits, such as, retirement benefits, any deductions, such as, if you have to pay into your own health care plans, right? Those are all just going to be stacked up and taken away from your paycheck after paycheck after paycheck, right? And other things such as state, which again, since we're in the state of Nevada, you're not subjected to state employment tax. So therefore, there is none that you have to be responsible for. Okay, so that's what you got to do. You got to list out that, well, this is the total amount of salaries and wages expense earned for this week, right? The things that are going to take away from that earnings is going to be your federal income tax, which we claimed at $11.13, the Social Security, which is claimed at $42, and then the Medicare is claimed at $9.95. So therefore, the overall check that L gets to walk away with is $622.62. Okay? So in this case, like I mentioned, the more you earn, the more taxes you're going to pay. And of course, if the company decides to pay into all these benefits and all these insurance plans for you, and it's a deduction to you, the less your paycheck is going to be, right? It's going to keep shrinking. Okay. So any questions in regards to the employee's taxes?